Subscribe to our YouTube channel and press the bell icon to get the latest updates.
In 1970, Asian Paints bought a mainframe computer for Rs 80 million. It thus became one of India's first private sector companies to own one. Since then, the company has digitized its inventory and billing management, which helped save time and cost. By the end of the decade, Asian Paints started using computerized color tinting machines. The company also trained employees to use personal computers in the 1980s and established a customer care helpline in 1990s. From centralized order booking to supply chain management to storage and retrieval systems, everything was automated by 2008. So for more than 50 years, Asian Paints has been collecting data on the color, size and quantity of paints purchased all over India. They continue to store proprietary data on paint demand for each neighborhood. This allows the company to predict paint demand well in advance. Recently, the company implemented state-of-the-art automatic truck loading systems in the two new plants at Mysuru and Visakhapatnam. They also use advanced artificial intelligence and machine learning to constantly improve the overall demand forecast. I now see several companies going the Asian Paints way. Yes, it's true. More than two-thirds of the listed companies in India have been undertaking technology-led capex over the past few years. Even the RBI capex data and company annual reports point to this fact. There's a sharp rise in the share of intangible assets other than goodwill in the balance sheets of companies. And the share of R&D expenses has hardly been as high as it is now. Skeptics may want to dismiss these data points as one-offs in the post-pandemic recovery phase, but they couldn't be more wrong. Here again, there are several data points that suggest that the capex will continue, more so the technology-related ones. First of all, India's corporate profits to GDP at about 4.5% is currently at a decade high. Though last seen in 2012, the sharp rise in earnings is backed by healthy balance sheets rather than macro tailwinds. Average operating margins currently at about 16.7% were last seen in 2005. The average net margins of 8.7% were last crossed in 2011. As companies were left loaded with debt in the previous capex cycle, there were few capacity additions in the past decade. This time around, India's corporate debt to GDP ratio at about 60% is significantly lower than the global average. Neither have companies splurged on expensive inorganic growth, nor have they kept their balance sheets leveraged. On the contrary, most chose to get leaner during the pandemic by paying off debt obligations. What is more, the lenders themselves are in good financial health. Not just private sector, but even public sector banks have seen profits soar in the past few quarters. Do note that India has moved from a 300 billion economy to a 3 trillion economy in the last 30 years. The vision is to become a 10 trillion economy by 2031. This transformative journey is backed by multiple growth vectors like broader demand from consumption with adequate support from the lower cost of capital and the proactive policy stance of the government. The reason I believe capex will be a game changer is because this time it is a vital cog in India's transformation. Gross fixed capital formation forms about 30% of India's GDP at about $790 billion. Public and private capex are stronger, while infrastructure and industrial capex were flat over the last decade. India has witnessed a sluggish investment cycle in the past decade after peaking in financial year 2011, following the recovery from the global financial crisis. This was characterized by the absence of large-scale capex in sectors such as power and metals. Of the 790 billion total gross capital formation, around 350 billion or 50% is in large industries and the rest are in infrastructure. Post-COVID demand recovery, higher commodity prices and better pricing power driven by industry consolidation are amongst the key drivers. Industry utilization is at a trigger point, 73.4%, highest in the last 12 quarters. For the top 5 players in most of the core sectors, cement, metals, power and refining, making a strong case for corporate capex. Order inflows based on recent data suggest that a healthy CAGR of 11 to 12% could be possible. Short cycle revenues of machinery and consumables and capital goods imports suggest that the investment cycle, which is building up, is strengthening. So, what's different this time? The diversity of demand. India is witnessing multiple tailwinds in terms of higher consumption and inflection in GDP per capita, better factor cost dynamics like personnel, money, material, etc., post-pandemic resumption of the economy, emerging opportunities to plug in business value migration opportunities from the global supply chains like China plus one, Europe plus one. Second, there is prudence in capital allocation. The larger size of the economy makes this capital cycle very interesting. It's also outcome centric, efficiency focused, and prudent in allocation. Thus, the economy offers a good local anchor for every asset creation that targets supply chain value migration. In the past cycles, commodity inflation and negative real interest rates had led to leveraged corporate capex cycles. This was also accompanied by crony capitalism, reckless investments, and substandard underwriting. Now it is replaced with a focus on economic profits, prudent underwriting, cash generation, and cash reserves for the corporates. Third, global geopolitical conflict. While the Russia-Ukraine conflict did affect supply chains in general and commodity costs specifically, it has accelerated trends such as alternatives to the existing overdependence on a single geography. India, with its large-scale established industrial base and knowledge-based service that represents intellectual property, is well poised to participate in this space. The post-pandemic urgency of localization has further increased the relevance of some large MNCs to leverage their Indian subsidiaries in the global supply chain. Global engineering companies such as Cummins, Siemens and ABB also indicate strong momentum for capex in their markets. The top 10 corporate groups are set to invest over $150 billion in multiple sectors within India. The banking system is in better health in terms of systems, capital adequacy, and ready access to buoyant local capital or long-term oriented growth capital to fund this growth. Finally, there's better policy support. The government is playing its part with policy framework that is incentivizing productive capital formation, catalyzing new investments with a proactive pro-business approach. It's also signing multiple bilateral trade deals with large markets like Australia, UAE and many more. There are two core drivers of capex in the near term: the Government of India's National Infrastructure Pipeline (NIP) and the capex plans of the private sector. In the NIP, roads, railways and power sector are some of the main drivers of capex. The private sector capex plans are across the board with special focus on clean tech and PLI driven capex in mobile, solar, EVs, battery technology, automobile, pharma amongst others. Remember, India witnessed a solid capex upcycle in the period 2003 to 2007. During this phase, the Sensex was up 7 times. But the actual stocks riding this capex upcycle went up 15 to 20 times during this phase. If you go by the current commentary of the bank managements, the capex cycle of 2020s is already here. There is a guidance of corporate trade growth, investment activity and gaining momentum. The boost from indigenization and increase in budget allocations is already evident in India's top stocks, like especially defense stocks. In 2022 budget, the government hiked its capex by 35% to 7.5 trillion and the number could go higher in 2023 budget. The PLI schemes have already been set in motion. These could have a multiplier effect on the corporate private sector capex. From a bottom-up perspective, the corporate balance sheets are cleaner with debt to equity ratio looking really good. The operating cash flows are higher too. The banks have cleaner balance sheets as well as they are geared up to lend more. The capacity utilization of corporate India has moved up from 68% to 74%. The sectors at the forefront of this capex evolution include road, rail, port, cement, logistics, oil and gas, renewables, power, defense, pharma, chemicals and textiles. Then there are also structural tailwinds. The global companies are looking for outsourcing beyond China. If India is a beneficiary of even a fraction of the demand, it could become a huge incremental growth driver over the existing base. Therefore, even as the world grapples with higher interest rates, both Indian corporates and their lenders are well equipped to take the risks in their stride. Major systemic risk due to capex boom is almost ruled out. In other words, the earnings per share or the denominator of your PE ratio could go up dramatically. This means stocks could start looking cheaper. So, as an investor, the least you could do is ensure that the companies you own are doing their bit in riding the capex boom. They should not only be allocating their capital judiciously, but also use the rise in cash flows and profits to build up capacities. Doing this will ensure that the stocks you own offer no negative surprises in earnings in 2023 and beyond. Hope you like this video. Thanks for watching.